Let's be honest, for the last 10 years, the story of crypto has been a story of wild, radical volatility. We've all seen the headlines about overnight millionaires. We've all felt that knot in our stomach checking prices in the middle of the night, wondering if we're on a rocket to the moon or a train hurtling off a cliff. That's the world of Bitcoin, of meme coins, of assets whose value is driven by hype and collective belief. For most people, it's felt like a high stakes digital casino. But what if I told you that was just the chaotic first draft? The necessary first chapter of a much bigger story? What if the true revolution wasn't about creating new forms of money from code, but about rewiring the ownership of everything that already exists? While everyone was distracted by dog themed tokens, something else was quietly building in the background. A sector that has exploded in value, recently surging to an all time high of over $33 billion. This isn't a niche experiment anymore. It's a tidal wave of institutional capital and real world utility. This is the revolution of real world assets, or RWAs, and it represents a monumental shift from a market of pure speculation to a market of real substance. It's about taking the groundbreaking tech of the blockchain and applying it not to abstract code, but to the things we can see and touch: the apartment building down the street, the loans that power small businesses, and the government bonds that underpin our entire financial system. This is where crypto grows up. Stay with me, because what you're about to learn will fundamentally change how you see the future of wealth. Before we can appreciate the solution, we have to be brutally honest about the problem. For all its trailblazing glory, the first era of crypto, dominated by Bitcoin, has some major flaws that keep it from being the foundation of a new global financial system. It was the pioneer, the one that kicked down the door. But pioneers are always a little rough around the edges. Let's start with the most obvious issue: the crippling volatility. Ask yourself, can you truly build long term wealth on an asset that can lose 20% of its value in an afternoon because of a single tweet? Can a small business accept a payment that might be worth way less by the time they need to pay their suppliers? For the vast majority of people and institutions, the answer is a hard no. Volatility isn't a feature, it's a bug. It makes financial planning a nightmare and turns investing into a game of trying to time the untimable. Sure, people have made money, but for every success story, countless others bought at the peak of a cycle, driven by FOMO, only to watch their savings evaporate. That's not a blueprint for a stable economic future. It's a roller coaster, and most people get sick on roller coasters. The second, and maybe deeper issue, is the question of intrinsic value. What is a Bitcoin or many other purely digital coins actually backed by? The honest answer is belief. It works on the Tinkerbell effect. It has value because enough people agree that it does. There's no underlying cash flow, no revenue stream, no physical asset you can claim. Its price is a function of market sentiment and speculative mania. It's a fascinating experiment, but when belief falters, there's no fundamental value floor to catch the price. That's a fickle foundation to build your financial future on. It's a huge contrast to the assets that have built wealth for centuries, assets that generate rent, pay dividends, or have real utility in the world. This environment has created a psychological nightmare for investors. The constant whiplash between fear of missing out, FOMO, when prices are soaring, and fear, uncertainty, and doubt, FUD, when they're crashing. It forces ordinary people to act like professional day traders, a game most are destined to lose. Is that really investing, or is it just buying a lottery ticket and hoping for the best? This isn't a eulogy for Bitcoin. It will always be a historically significant asset that proved the concept of decentralized digital scarcity. But the proof of concept is rarely the final product. The Wright brothers' first plane was a marvel, but you wouldn't fly it across the Atlantic. The first wave of crypto was a brilliant speculative experiment, but now that same technology is being aimed at a far more stable and valuable target. So if the first wave is a casino, where do serious investors find real value on the blockchain? The answer has been hiding in plain sight all along. It's not in creating new assets from code, but in transforming all the existing assets in the world around us. Imagine you could take a skyscraper, a portfolio of business loans, a bar of gold in a vault, or even the future royalties from a hit song, and represent them as digital tokens on a blockchain. That's the core idea behind real-world asset tokenization, or RWAs. It's not about inventing value out of thin air. It's about taking the existing tangible value all around us and upgrading it for the digital age. Simply put, tokenization creates a digital deed for a real-world asset. This digital token lives on a blockchain and carries all the ownership rights of the actual asset. If you own a token representing a piece of a rental property, you are legally entitled to your share of the rental income. If you own a token for a government bond, you get the interest payments. The token isn't just a symbol, It's an enforceable claim on a real income producing asset. This simple concept is revolutionary because it builds a bridge between two massive, previously disconnected worlds: traditional finance, TradFi, and decentralized finance, DeFi. Trillions of dollars are locked up in traditional assets that are often slow, opaque, and inaccessible to the average person. DeFi, on the other hand, is fast, transparent, and open, but has mostly been a self contained digital playground. RWA tokenization is the bridge that lets value from the traditional world flow into the digital one, getting supercharged with all the benefits of blockchain technology. And this is exactly why the titans of finance, the same institutions that were once crypto skeptics, are now rushing into this space. We're talking about BlackRock, JPMorgan, Fidelity, and Goldman Sachs. They aren't just dipping their toes, they're actively building tokenized products because they see the undeniable benefits. So, what are these benefits? Let's break down the pillars of the RWA revolution. First, and most importantly, it democratizes access. For centuries, the best investments were reserved for the wealthy. Want to invest in commercial real estate or a private equity fund? You needed millions in capital and the right connections. Tokenization shatters these barriers. A $10 million office building can be divided into 1 million $10 tokens. Suddenly, an exclusive asset is accessible to a retail investor anywhere in the world. Second, it unlocks global liquidity. Many of the world's most valuable assets are incredibly illiquid. You can't just sell the top floor of a building on a Tuesday afternoon if you need cash. The process is slow and full of middlemen. Tokenization changes that. By converting the asset into tradable digital tokens, you create a 24/7 global market for it, transforming static, dormant value into dynamic, tradable capital. Third, radical efficiency. Traditional finance is bloated with intermediaries. Buying a house involves agents, lawyers, banks, and insurers all taking a cut. RWA tokenization, powered by smart contracts, automates much of this. Smart contracts are self-executing code that can automatically distribute rental income to token holders or execute trades without a broker, making transactions faster and cheaper. Finally, unbreakable transparency. Blockchains are permanent distributed ledgers. Every transaction is recorded transparently, which drastically reduces the potential for fraud and disputes that plague opaque, paper-based systems. It builds trust directly into the market's DNA. This all sounds great in theory, but is it actually happening? Yes. The market for tokenized real-world assets crossed $30 billion in Q3 2025. And analysts are predicting this market could reach anywhere from $2 trillion to a mind-boggling $16 trillion by 2030. The names involved aren't obscure startups. They're the biggest players on Wall Street. This isn't a distant future. It's happening right now. We're about to dive into the specific types of assets being tokenized right now, from digital real estate to the very US treasuries that back the global economy. If you're getting value from this breakdown and want to stay ahead of the curve on the biggest trends in finance, take a second to hit that subscribe button. It tells us you want more deep dives like this. Okay, let's get into the exciting part. The real-world examples of this revolution in action. This revolution isn't just a concept. To make it tangible, let's explore three key categories of real-world assets being transformed by tokenization right now. Case study 1. Real estate, the digital landlord. Real estate is the world's largest asset class, but it's also one of the hardest to get into. The old way: save up a massive down payment, qualify for a mortgage, and deal with endless paperwork. Then you become a landlord, which means dealing with tenants, toilets, and taxes. It's a high barrier, high headache job. Now, the new way: tokenized real estate. A company buys a property, say an apartment building in Miami. Then a platform like Realty or Lofty issues digital tokens on a blockchain, each representing a small fractional share of that building. That multi-million-dollar property is now divisible into shares that might cost just $50. As a token holder, you get a direct economic stake in a real building, but the magic is in the automation. A smart contract collects the rent and automatically distributes your share of the profits directly to your digital wallet. You become a digital landlord, collecting rental income without ever fixing a leaky faucet. This collapses the barrier to entry, gives you global access, and provides liquidity you could never get with a physical property. Case study 2. Private credit and bonds, the blockchain bond market. This next category might sound more complex, but it's where massive institutional money is flowing. When you buy a bond or invest in private credit, you're lending money to a government or a business and earning interest. Historically, the best of these opportunities have been out of reach for regular investors. Tokenization is blowing the doors off this exclusive club. We're seeing an explosion in tokenized US treasuries, considered one of the safest assets on the planet. The market for tokenized treasuries has surged to over $8.4 billion as of October 2025, and this is where the giants are making their moves. BlackRock, the world's largest asset manager, launched its own tokenized fund called Buidel in March 2024. Why? Efficiency. Blockchain transactions can settle almost instantly 24/7 instead of taking days. Following their lead, Fidelity and JPMorgan are also deeply involved. For you, this means the stable yield generated by these institutional grade assets is now becoming accessible on the blockchain. The growth has been astronomical, with tokenized private credit now the single largest RWA sector, surpassing $17 billion in value. Case study 3: exotic assets, from gold bars to carbon credits. This last category shows just how versatile tokenization is. Think about all the other valuable stuff in the world: gold, fine art, rare whiskeys, and even carbon credits. These assets hold immense value but suffer from extreme illiquidity. Tokenization solves this. Projects like Pax Gold, PXG, have created tokens where each one is 100% backed by 1 troy ounce of physical gold in an audited vault. Suddenly, you have an asset with the stability of gold and the speed of crypto. You can send $10 worth of gold across the world in seconds. The same logic applies everywhere. Platforms are tokenizing shares in artworks by Warhol or Banksy. Others are tokenizing carbon credits, which are permits for CO2 emissions. The global carbon credit market was valued at over $900 billion in 2025, and putting it on-chain creates a more transparent and efficient global market. This incredible flexibility shows that any asset with value can be tokenized, opening up a universe of new investment possibilities. Okay, let's pump the brakes. It would be irresponsible to paint this picture without talking about the hurdles. This space is promising, but it is not a risk-free paradise. The single biggest challenge is regulatory uncertainty. Regulators like the SEC are still figuring out how to classify these assets. Most are likely to be considered securities, which means platforms must comply with a complex web of financial regulations. Navigating this legal minefield is complicated and the rules can change. Second is the liquidity illusion. Just because an asset is tokenized doesn't mean there will be a deep market of buyers and sellers for it. Some RWA tokens can be hard to sell quickly without taking a lower price. It's crucial to assess the maturity of the specific market you're entering. Third, we can't ignore tech and security risks. Blockchains and smart contracts are powerful, but a poorly written contract could be exploited by a hacker. The platform you use could suffer a security breach. It's vital to choose reputable platforms that undergo regular security audits. Finally, there are the legal and tax headaches. When you buy a token, you typically own a share in a legal entity that owns the asset. Understanding your rights within that structure is key. Furthermore, the tax treatment for income from these assets is still evolving and can be complex. These challenges aren't reasons to dismiss the RWA revolution, but they are a reminder that this is not a get-rich-quick scheme. It requires due diligence and caution. As always, this is not financial advice, and you should always do your own research. So, where does that leave us? We've gone from the high-stakes casino of early crypto to the emerging world of real-world asset tokenization, a world built not on hype, but on the tangible value of the world around us. The key takeaway is this: the crypto revolution is growing up. It's shifting from chasing 100x meme coins to building sustainable wealth by owning fractional pieces of real income-producing assets. It's the move from pure speculation to undeniable substance. This transition is being led by the largest financial institutions on the planet. BlackRock and Fidelity aren't just playing around, they're deploying billions because they know tokenization is the future of financial infrastructure. It's a fundamental upgrade to how we own and trade value. This isn't a distant maybe. The market is already worth tens of billions and growing exponentially. The tracks are being laid for a future where a huge portion of the world's wealth is on-chain, accessible to anyone with an internet connection. But this conversation is just getting started. I want to know what you think is the most exciting real-world asset to be tokenized. Is it real estate, private credit, art, or something else entirely? Drop your thoughts in the comments below. I read every single one. And if you want to keep exploring the future of finance, make sure you're subscribed with notifications on. Click here to watch our next video, where we dive into the top RWA platforms you need to know about. Thank you for watching.